Okay, I'm going to go to share screen. And first thing I'm going to share, do you guys see this Excel?
Yes.
Okay, so this is an Excel sheet I put together just to illustrate a couple of things. And I'll show you guys how I did this, of course. So let me just bold this so you guys can see it better. And I'll bold this. So on these two columns that I just bolded, this is the S&P 500 number, and the stock track number is the value of your stock track portfolio as of the same date. And stock track this semester, we started, I think, September the 7th, and it ended November 16th or something like that. And so what I'm showing here is the value of a fictitious stock track portfolio, but the actual S&P 500 for the same day of every week over the stock track program. Does that make sense? Any questions on that?
That makes sense.
Does? Okay. So again, these numbers I just pulled out of the air because I just wanted to show some stock track results. So we all started off with $100,000. A week later, I'm saying this fictitious portfolio is up 1,000. Week later, it's up another couple thousand. Next week, it dropped by $4,000, went up by 100, blah, blah. By the end of the stock track exercise, this fictitious portfolio, I lost $18,000. Fair? So an 18% decline. Meantime, the S&P 500 over the same time period, these are real numbers, went from 3340 up to 3626. Fair? So stock market did good. This fictitious portfolio did badly. Now I can make these numbers be anything. I really don't care. If you wanted, if you want this to do better than the S&P 500, we can put those numbers in, right? It's okay. So you got what I'm trying to say. Are you all okay in terms of where to find the S&P 500 numbers for a certain day of the week? Remember, I asked you to track it, say every Monday or every Tuesday or whatever, one day a week for every week while you're in this game. Are you guys okay with where to find that number? Anybody not?
Could you show us again?
Sure. So let me, because I was waiting for someone to ask me to do that, right? So let me stop sharing this. And let me instead go and share the internet. So I'm gonna go to, remember Yahoo Finance, and I'm gonna type in here S&P 500, and this thing will show up. The tilde, the hat number, which is above the number 6 on my keyboard, and then GSPC. That's the ticker symbol, so to speak, for the S&P 500. So I'm going to choose that. And here, load. And today, the S&P 500 was up like 14 points, 3581. And a lot of people talk about the Dow Jones, and that's kind of almost 30,000. But remember, the Dow Jones Industrial is like 30 stocks. This is 500 stocks. This is a far more broader measure of the stock market, though the Dow Jones Industrials is also seen as a proxy. But I like this one better because it's broader. It's got 500 stocks in it. So, and this is usually the one, news media aside, pardon me, that is taken as representing how the stock market as a whole is doing. So, okay. So over here where my mouse is hovering, can you guys see historical data? Can you see that?
Yes.
So I'm going to click on that. Fair? Clicking on that. I guess double click it, sorry. And now it'll show me the S&P 500, you know, every day going back, right? So today's the 19th of November, and then going back. And what I want to do is I want to just look at the S&P 500 while we had our stock track game. So from September 7th, say 2020 till today. So that's my range, right? I'm specifying a range, and I'm going to hit apply. Oops. And then I also want to do it weekly. That's me. So apply. And let's see what it did. So there it is, November 16th. And then a week before, November 9th, November 2nd. Right? I mean, what displays is up to you, but this is what I was interested in. And then do you see underneath apply, there's a thing called download. Do you all see that?
Yeah.
Okay. So I'm going to click on that. And then what downloads, it's this CSV file, which is really an Excel type of file. It's a spreadsheet, and it's called tilde GSPC 15. 15 because I guess I've done this. Now this is the 15th time. Fair enough. Otherwise, wouldn't have that number in front of it. So I'm going to click on that, open it. And okay, you can't see this because it's now showing an Excel file. So I'm going to stop sharing. And then I'm going to now share the screen. Oops, I got a chat question, number one. Professor, my team member and I bought a stock, but our profile says we don't have any transactions done. Is it possible that it was deleted? I doubt it. Now, you may have put a stock order in, but because you put a limit in, it never got executed. That's possible. But you can still access, you can't do any more transactions, the game is stopped, but you can access your portfolio and it should, your stock track, and it should show whatever stocks you had by the end of the game, assuming you haven't sold them. Fjord, does that answer your question? Fjord? Well, she didn't answer me, but this GSPC 15, this is the file that opens as a result of me downloading the S&P 500 historical data that I showed you. Any questions on that? Let me broaden this column so you can see what it is. William, did that make sense?
Yeah, it did.
Okay, good, good. Awesome. So what I did with the Excel file that I showed you earlier, that one. Here is the S&P 500 data. I just want to show you that's where I got it from. Fair? And then the stock track numbers, that comes from your portfolio as of, again, whatever the value is as of the same date as the S&P 500. So I've listed those here. Then in the column next to, say, the S&P 500, this column, column C, can you all see that?
Yeah.
Okay, thanks, James. Column C, this is how did this number in column B change? So between September the 7th and September the 14th, the S&P 500 dropped by 21.5. So this in C is B3, right? The one to the left, minus B2, the one above it. Similarly, you know, on October 19th, the S&P 500 had dropped 18.42 points from the week before. Again, it's B8 minus B7. Do you see the formula?
Yes.
So this is the change in the S&P 500. Similarly, this is the change in the stock track portfolio, right? It went up by 1,000, went up by 2, went down by 4, blah, blah, blah. Okay. Then the column next to this, next to the actual change, or the number change, converts the change into a percentage. So it takes this change, the 21.5, the minus 21.5, and it divides it by the beginning number, meaning the beginning of that week. So the 21.5 divided by the 3,340 equates to minus 0.64%. The 128 increase here on October the 5th divided by 3348, the number of the week before, right? The beginning of the week number, it's a 3.8% positive increase. Do you see it? C6 is this change divided by B5, not by B6. Is that percentage change formula understandable?
Yeah.
We good? So we got the actual change in column C, the percentage. What does that mean from a percentage basis? Column D. Yeah, Blake. Blake, did you have a question?
No, that was an accident. My bad.
Oh, no problem. No problem. Don't worry. So, and then here we've done the same thing with the stock track numbers. Here's the actual change, went up by 1,000. In this case, it's dollars, but S&P is not dollars, just a number. And this 1,000, that equates to a 1% change, etc. Okay. So in these columns here, A, I, and J, all I did is basically copy over the change numbers here, right? This is the change numbers for the S&P 500 minus 0.64. There it is, minus 0.64. Here, and on the same day, here's the percentage change for stock track, 1%, there's 1%. So this is just a duplication, but side by side of what I calculated here. So that's all that is. All right. Now comes some math. So stick with me. First thing I want to do is here are the weekly changes. Yes. What is the average weekly change? Also called the mean, but the average weekly change. And there are basically, I think there are 10 numbers. Let me count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. In my case, there are 10 numbers. Now, if you played the stock track game for fewer weeks, you'll have fewer numbers. Fair? However many weeks you played it. In my case, there are 10 numbers. So to take the average, you add them, divide by 10, right? That's easy. And there's an Excel function called, do you see it? Average. So average, and then it gives the range from D3 to D12, which is D3 is this first number, D3, and D12 is the last number, right? And so the average, this average function, brackets, first cell, then colon, the 2 dots, and then the last cell, close brackets. That gives you the average for these 10 numbers. Now, if there are 8 numbers, you give the average for the 8, right? It's just an average formula. So it's a number, it's add them all up, divide by however many numbers you have. Same thing.
Professor?
Yep.
I just want to ask a real quick question. Is there a centralized place where the rubric for this assignment is going to be posted? Because I just worry I'm going to leave something out and then.
Well, so yeah, no,
Yeah,
fair
I
enough. Ingrid, can I first go through the math? Because I'm asking you guys to do this math for your stock track assignment. Is that okay, Ingrid?
Yeah, I just wanted to ask if there was going to be a place where it was listed.
Yeah, so I'm showing you how to do the math.
Go ahead, absolutely.
I'm recording the lecture, and I'm going to post the recording of this lecture on Canvas and any other data you need. And in case you came in late, I recorded the insurance lecture and the investment lecture and the amortization lecture, and they're all posted on Canvas for you to look at if you have the time. So it's the whole lecture. It's not a condensed version. So all 2 hours. Okay, Ingrid? So it's going to be on Canvas, I guess. I don't mean to step your answer. So but that's the answer, but I want to do the math first. So
Professor,
yes, sir.
can we still turn in the amortization
Yeah, absolutely.
homework?
No problem.
Perfect. Thank you.
Yeah, you're welcome. So are we good how I calculated the average here?
Yeah.
Yeah, we're all good. All right. So the average weekly change in this particular case is 0.88% a week. For my fictitious stock track portfolio performance, it's minus 1.5% a week, right? And then the next thing to do is to calculate the standard deviation. So the standard deviation is a measure of the range or dispersion of the numbers that are out there in our sample around the mean. In other words, the average is 0.88, but as you can see, you know, one of the weekly changes was plus 7%, right? Another one was minus 0.64. So the numbers are all over the place. So how broad is this range of numbers around the mean? Well, how do we measure that? And one measure of that is called the standard deviation. And here's the Excel function, ST, standard, I guess, and then DEV for deviation. Can't get the words out. And then here's the range, again, D3 through D12. So let's see, standard deviation. Bear with me. There it is. Here's a graph of it. And if this is the average right here in the middle of this normal distribution, it assumes a normal distribution, and you have one standard deviation to the left and one standard deviation to the right of this average. See these numbers is kind of a little blurry, but 34.19%. So to the left, 34.19% to the right. So add them up, 68.38%, 68 plus percent of all the data numbers that you have are within plus or minus one standard deviation. If you go two standard deviation, well, then you capture an extra 13%. So 13 plus 34, 47, almost 48. And then 48 plus 48, 96. So between 95%, a little bit like that, 95% of all the data that you have is within two standard deviations to the left or to the right, plus or minus two standard deviations. And if you go three, well, then you add another 2%, and you're basically going to be 99% of all the data is within plus or minus three standard deviations. We good?
Yeah.
All right, so a little bit of review of a statistics course, really quick, on this component that hopefully you've had in high school or in some other class at college, a statistics college, but it's a measure of the dispersions. That's what a standard deviation is. So now let's think about it from stocks, because that's what we're talking about. And remember, if I can get to it, I forgot what sheet it is. Oh, here it is. Stock track, your portfolio, I mean, is what it's either all cash if you haven't done a single trade, or it's cash and however many stocks you bought, right? S&P 500 is 500 stocks, right? Some combination of those based on their market capitalization and some big denominator. All right. So it's just a number that represents the market capitalization of the 500 stocks. But so standard deviation shows you here in the stock track the range of change in the dollar value of this portfolio, right? And if the portfolio, so as we're talking about investment stocks, Portfolio can go up, portfolio can go down. If the range of changes, the ups and downs, is wide, if the standard deviation is big, right, that means it's risky. It's not that stable. It can be up a lot, down a lot. So standard deviation is a measure of the volatility of this number that we're looking at, and volatility is a measure of risk. If it wasn't volatile, it just stayed the same all the time, then there's no risk. The fact that it can go up, help us, go down, hurt us, that change is and it shows the risk that's in there. And the standard deviation is a measurement of that absolute risk. You want to talk to me about that question? Did that kind of sort of make sense from a theoretical perspective?
I just have a question about the stock track numbers.
Sure.
So, is there a place in the stock track where we can see that? Because I didn't record my numbers weekly down.
No, you can. What you do is when you look at your stock track portfolio, it says as of a certain date. So that change the date, make it September 14th, and it'll tell you what your stock track portfolio was worth as of that date.
Okay, thank you.
Yeah, you're welcome. Good question. Are we okay with my monologue on standard deviation? Did that make sense? Kinda. As a measure of risk, absolute risk. Because it measures the changes that can happen from the average, from the mean. All right, well, think about that a little bit. So this average, therefore, here are the weekly returns, is an average of the returns of the gains or losses, and this is a measure of the risk. So we're measuring return and we're measuring risk. Now, what this lecture is going to be about is to talk to you about something called the Sharpe ratio, which combines this reward, this return and risk factors. So, and what the Sharpe ratio is on the numerator is the return, and we'll go over that in a moment in more detail, and the denominator is the risk as measured by the standard deviation. So if a particular investment has a bigger return, the numerator is bigger, the Sharpe ratio is going to be bigger. If it has a lower risk, standard deviation is smaller, the denominator is smaller, the Sharpe ratio is going to be bigger, right? Divide by a smaller number, you get a bigger result. So the bigger the Sharpe ratio is, the better, as a measure of how good of an investment you're looking at. Are we good with that in concept?
Yeah.
So the beautiful thing, what I love about the Sharpe ratio is, listen, if you go to a roulette table, right? That's one of my examples. You bet everything on black or red. You know, there's a, I don't know exactly, but like 49% chance it'll be black, 49% chance it'll be red, don't quote me. And then there is like a 2% or whatever chance it'll be 0 or double 0. Fair? So it's, you know, you can either double your money if you bet your money on black and it hits black. Okay, you double your money, or you can lose it all. So the return is big, you can double your money, but the risk is big too, you can lose it all. Now, how does a roulette investment compare to investment or gamble compared to an investment in stocks? Well, again, you can look at the risks in the standard deviation of the stock portfolio that you have, or the particular stock, and you look at the return, and that combination will give you a Sharpe ratio. And you can figure out the risk and return on a roulette table and give the Sharpe ratio for that investment class. So this way you can compare two disparate, I'll use the term investments to see which one is more effective. Which one has a bigger Sharpe ratio, where the return risk is more attractive. Fair? All right. So let me get you guys to see how to calculate this. So we calculated the average, we calculated the standard deviations. Once again, I'm sorry, just double checking. Are you guys okay with how to calculate a standard deviation, how to calculate the average? If not, ask. We good? All right, so in the absence of questions, I'll move along. So here I got something called the Treasury bill rate. So Treasury bill is when the government, our government, the US government, the US Treasury, when they want to borrow money, they issue these bills for short-term borrowing needs. And you as a consumer can invest money, purchase a bill, Treasury bill from the government, which is the same as lending money to the government and they'll give you a fixed interest rate return. And this is considered a risk-free rate because when you lend money to the government, you're guaranteed, no question, that you're going to get your money back. You know why? Why are you guaranteed that you're going to get your money back? Impossible that that'll fail. Why? No one.
Is it because it's the government?
It is the government, but what is it about the government that makes it a foolproof deal? What does the government have access to?
Access to the money, the printing of money?
The printing of money. They have the money tree. It's a high-speed printer. Print the button, bzz, there come the dollar bills. And they can print, theoretically, as much money as needed, right? So when you lend them your money, they're guaranteed that they can pay you back. So they'll pay you your money back plus a return, little interest rate. And this rate of return, in this case, the Treasury bill rate, is considered a risk-free return. In other words, if you give it to the government, right, you don't take any risk, you're guaranteed to get your money back. So if you really want to measure how well you are doing on your investments, you need to compare your returns with this risk-free return. And your actual return is not as meaningful as how much more your return was relative to the risk-free rate. Because the risk-free rate, you got a rate for no risk. Your rate, your return, you got that return because you took risk. So it's the extra return you got for the extra risk that you took that is meaningful. So far, so good?
Yep.
Okay. And I'll show you later how to find the Treasury bill rate. Let me continue with this map site, and then I'll, just like I showed you how to get the S&P 500, I'll show you how to get the Treasury bill rate. So we'll go back to that. So Treasury bills are always quoted. In fact, all interest rates are quoted on an annual basis, right? Your mortgage, got a 3% mortgage. You're not paying 3% a month, right? 3% is the rate for the whole year. Fair? So what we got to do is convert this weekly return and this weekly standard deviation into an annual return, and an annual standard deviation. So the annualized return is this weekly return times 52, because there are 52 weeks in the year. So that's easy. Agreed?
Yeah.
Okay, so all I did is I took D15, which is 0.88, which is the average of this stuff, and I multiplied it by 52, and I get a 45% annual return, meaning, right, exactly what it says. If the S&P 500 did continue to do what it did in this 10-week period, right, while we had the game, if you continue to do this for a year, after a year, we should get a 45% return. I mean, huge, right? And again, the average stock market return is, what did I say? About 12%, right? 8-9%, and then plus the 3% dividend yield. This doesn't include the dividend yield. It's just the stock market. So 45%, huge. And so 45%, 45.51% is 45.38% more than the treasury bill rate. So this is the risk adjusted return, which is our annualized return minus the treasury bill rate. So this is our return annual over and above the risk-free rate. This is the extra return we got for taking the extra risk. And what I'm saying we got, that the stock market got for stock market risk. Fair? Questions on that? Okay, so this is in the numerator of the Sharpe ratio. Now we want to do is get the annualized standard deviation. And unfortunately, you do not multiply the weekly standard deviation by 52. No, wish it was that simple. You multiply the weekly standard deviation by the square root of 52. Sorry. And if we had a monthly return instead of a weekly, in order to annualize the monthly standard deviation, we would have to multiply the monthly standard deviation by the square root of 12. Return, we just multiply by 12, but the standard deviation we have to multiply by the square root of 12. In this case, it's the square root of 52 because it's not monthly, it's weekly. I don't know why I'm talking so fast tonight, but hopefully it's not too fast. We doing okay? Class, would you like me to say any of that again?
Yeah, could you repeat that again?
The standard deviation part?
Yes.
Okay. So are you okay with the return side that we take a weekly return and just multiply it by 52 to get the annual return?
Yeah.
Okay. So with the standard deviation, instead of multiplying by 52, we multiply it by the square root of 52.
Okay, gotcha.
Right?
Yeah.
And then what I said is, let's say we had a, so don't lose that. We got that. But let's say we, instead of a weekly return, we're measuring a monthly return. The monthly return, you got to multiply by 12 to get an annual return, 12 months in a year. That's easy. But with the standard deviation of a monthly return, you got to multiply that by the square root of 12, not by 12. So it's that square root extra step when it comes to standard deviations. We good?
All right, thank you.
Yeah, you're welcome. Okay, just to add it for completeness, if you had a daily return, to convert the standard deviation of a daily return into an annual, this is, again, I'm just going to tell you, you got to multiply by the square root of 250, not by the square root of 365. And the reason is because there are approximately 250 trading days during the year. The rest of the time it's weekends, you know, when the stock market is closed, and, you know, Christmas and New Year's and that kind of stuff. Thanksgiving. Fair? All right, so here's the Sharpe ratio. The Sharpe ratio is, can you guys see the formula up here? D20 minus D18. D20 is the annualized return minus the treasury bill rate. So that is the same as D21, the risk adjusted return, and divided by D23, which is the annualized standard deviation. And so the Sharpe ratio for the S&P 500 over this 10-week period of time is 186.93. We good with that? I mean, it is what it is, but that's the number. We okay with how the Sharpe ratio is calculated?
Yeah,
Class? Yeah, Zena?
I said, yeah, it made sense.
Kinda, huh? Thank you. Thanks for that feedback. Appreciate it. And so the same math is here for the not the S&P 500, but for the stock track, our stock track numbers. So in my pathetic example where I've lost, 20 grand, $18,000, my average weekly return is minus 1.5%. The standard deviation of that return is 9%. I mean, it's much wider than the S&P 500. It's more risky. And let's look at it. Yeah, the biggest negative was minus 22%. The biggest positive was 11. Remember, with the S&P 500, the biggest negative was minus 5.6, and the biggest positive was 7, right? So much narrower range than my minus 22 and plus 11. So of course, standard deviation is bigger, much broader range of possible results, much riskier portfolio than the S&P 500. The treasury bill rate is still 0.13. My annualized return is minus 1.54 times 52. And my risk adjusted return, again, it's a minus number, minus 80%. In other words, if I kept doing this for the whole year, I'd have lost 80% of my money. I'd be left with $20,000 out of the 100,000. Okay. And my risk adjusted return, which is this 79.88 minus the 0.13, is I'm actually doing 80% worse than the risk-free rate. The annualized standard deviation is this 9% times the square root of 52. And the Sharpe ratio is this minus 80% divided by this 67.4. So look at this. My Sharpe ratio is a minus 118. The S&P 500 is a plus 186. Which one's better? I know you guys all know the answer. Just being Captain Obvious. Go ahead, James. You're gonna make me feel better. Which one's better?
The 180, the positive 186%.
For the S&P 500. Yeah, the bigger the Sharpe ratio number, the better it is. This one obviously bigger, not only plus, but yeah, just being plus makes it bigger. But plus by big number. All right. I'll be back to this.
So you want us to find the Sharpe ratios of our entire stock track performance or of specific stocks?
Of the whole stock track performance. Great question, Ingrid. As usual, you always have great questions. Of the whole stock track portfolio. But you could, if you wanted, do this same exercise, and instead of showing the stock track portfolio, you can show the stock price of a certain stock on that date, right? 1 day a week. Find the average change in that stock price, percentage-wise, get the standard deviation of that change, and therefore get the Sharpe ratio for that stock.
Okay. So just for the whole stock track then, and for this particular project, is there going to be, sorry, last question, I promise I'll make it quick. Is there going to be a listed assignment rubric listing what you
Yeah.
want to see in
Yes,
on
yes,
the,
yes.
just so there's a checklist in my head, because I think like that. I just want to make sure.
Well,
that's there.
again, I'm not sure if it's a checklist per se, but it's a report, and I'll show you what I want in that report. And part of that report
Okay.
is this calculation that I'm showing you how to do.
Oh, fantastic. Okay, thank you.
Okay, sure. And again, I don't mean to go over, but you never ask too many questions. I love questions. So Ingrid, keep asking. Don't apologize, just ask. That helps everybody. Helps me. All right, so now I'm going to go back to the internet and I'm going to go to Google search. It shows up and I'm going to hit, I've written it before, Treasury bill rates, right? That's on the search. And what'll show up here is, I hope when you guys do the search, is this website, which is www.treasury.gov, government website for treasuries. And so I'm going to click on that and that should open it. So here's the treasury.gov website. And right here is daily treasury bill rates data. So here it is, say, as of 11/2, and then this one goes forward instead of back. So 11/3, there's 11/17. And so here's a 4-week treasury bill. That's the rate. Here's an 8-week treasury bill. Here's a 13-week treasury bill. Here's a 26-week treasury bill. Let me move this thing aside. And then 52 weeks. See that? When it's longer than 52, when it's longer than a year, then it's a treasury bill note instead of a treasury. It becomes a treasury note instead of a treasury bill. And then when it's longer than 10 years, it becomes a treasury bond, right? So it's still treasury, our government borrowing money, but this is short week borrowings, or from our side, if we lend them the money, short week investments, right? 4-week investments, 8-week, 13, 26, and 52. So what I'm interested in is what was the treasury bill rate when Trak started, because that's the alternative. When we started on September the 7th, we could have put our money with the treasuries, right, for 12 weeks, covering this Trak period. And that's the return we would have gotten risk-free. So that's the return I want to use as a benchmark to compare our actual returns to. So here I put in for 2020, I'm going to hit go. And then that'll load it. And then let me now go down, because this is for all of 2020. And we started the beginning of the year. Now we're at March, April, May, and I want to get to September, which I'm pretty close to. And there it is, September. Well, there's no 7th, oh, there, 8th, good enough. And there it is. Hold on, 1, 2, 3, 4, 5, 6. There it is. For the 12-week treasury bill rate as of September 8th, it was 0.13. Fair? Are we good? How you can find the treasury bill rate for any day? So if you didn't start September 7th, you started September 17th, then your treasury bill rate would be different, right? Instead of 13, it may be 11. I don't know, whatever it was. Questions on that?
So does it lock in at that rate until whenever you decide to take your money out? So it won't change over?
No. It locks in that rate until it matures.
That's what I meant. Yeah. It
But
locks in
wait
that
a
rate,
minute.
it doesn't change.
Because Ingrid, if you wanted to, you can always take your money out earlier. You don't have to wait till it matures. But the risk you take is when you take the money out earlier, you're not exactly sure what you'll sell it for, depending on what rates are. And you may not get that promised return. And again, promised return. So this is 0.13% for a year. So and you're only having it for 12 weeks. So you're not even going to get the 0.13. Are you with me? So if you take it out earlier, you may lose money. I don't know. Does that make sense? The rate is only guaranteed if you keep it till maturity. Fair, Ingrid?
Yes. Thank you.
You're welcome. So now let's go back to Excel. All right. So now I'm going to show you something, to me, that's super, super cool. But are we good so far on this Excel sheet? And good meaning, are you comfortable in doing this with your data?
Yes.
Awesome, Caleb. Glad to hear that. Anybody have any questions or want me to repeat anything that I've spent the last 50 minutes talking about?
So we would do this for like each stock.
No, William. This is, I mean, you could, but I'm not asking you to. For the purpose of this exercise, you're doing this for your stock track portfolio as a whole. What is it worth every week? You start off with 100,000, right? Whenever you started, a week later, what was it? Was it 100,050 cents? You know, what was it?
Oh, okay. Makes sense.
Yeah. Okay. Any other questions?
How did you get those percentages and the decimals off to the right?
Off to the right. Give me a column number.
Column M and column N.
Oh, these numbers. Oh, okay. I didn't actually go over those with you guys, but you know what I did here. Yeah, let's do that. It's okay. So I was testing the standard deviation result. Just want to make sure the computer was doing it right, that I had the right function in. So the way you measure standard deviation is you take the data point, in this case, so let's look at the S&P 500. You take the minus 0.64%, that's a data point, and you subtract from that the average, the 0.88, fair? And then you square it in order to get rid of any negatives. And you then add the square of the differences between each data point and the average. You add them up. You divide by the number of data points minus 1, dividing by a lower number to kind of get a bigger result, be a little bit more conservative as far as, you know, calculating what the standard deviation is, and then taking into account it's a smaller sample. So just a little bit more conservative. And then to get rid of the squaring that you've done, you take the square root of the whole thing. And that's how you get the standard deviation. So here is G, okay, in this case, I did, forgive me, I did the stock track, same thing. So I took G3, that's the 1%, and I subtracted from that G15, that's my average, the minus 1.54%, and I got 2.54%, right? 1 minus 1.54 is minus times minus makes a plus, right? So 1 plus 1.54 makes 2.54. And I've done that for every data point, for the 1.98, for the minus 3.88, blah, 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 right? And then here, what I've done is I've taken the square of that number to get rid of the minuses. That's the standard deviation calculation. And over here, over where is it, Raj? Oh, it's disappeared. Well, we can do it. So here, I'm going to sum them. I'm going to divide this by the number of data points minus 9. We had 10 data points, so I'm going to divide it by 9. And then I'm going to take this and take the square root of it. God willing, that'll be the right one. 9.36. And there it is, 9.36. See it? So all I did is manually calculate the standard deviation to make sure I get the same number. Did that answer your question?
Yeah. Thank you.
You don't need to do that, right? This is just, because I used a standard deviation that was kind of a different function and divided it by all the data points by 10 instead of by 10 minus the data points minus 1, and just, okay, so that really confused me. So this is the right one. The standard deviation function is STDEV for Excel. Thumbs up? Okay, thanks, James. All right, now let me show you something cool. Okay, so if you, okay, this doesn't work for Google Sheets, and it may not work if you have a Mac, sorry, but, and if you have a Mac and if you have a Google Sheet, you don't have to do this. But if you have, you know, Microsoft Office Excel or regular PC, then this is what you do. You go to File, and underneath, way at the bottom, is something called Options. Do you guys see that?
Yes.
Awesome. Click on Options, and this thing appears, this box appears. And at the very to the left, again, this menu, choose Add-ins. Add-ins. So I'm going to click on that. And one of the add-ins, so these are things, functions that you can add into Excel that makes Excel that much more powerful, right, as a tool. And one of the add-ins is this thing, the Analysis Tool Pack, whole bunch of stuff. So you choose that, and you know, you hit OK, and that'll install it. Fair? So of course on my Excel, I've already done that, so I don't need to install it. And if you go to, okay, up here in the menu, File, Home, go over here, it says Data. You see that? Click on Data. And way to the right is this thing called Data Analysis. So I'm going to click on that. And this Data Analysis function came in because I added the Data Analysis Tool Pack to my Excel. I had to like download it, right, the way I showed you. So I click on Data Analysis, and here are all the things you can do. I mean, mostly statistical stuff, right? Fourier analysis, histograms, moving averages, kind of a cool thing. Anyway, so the one I'm looking for is regression. Regression. And it's kind of a weird word, right? I mean, like regressive. It's kind of like you're going backwards, but no. So what regression means is if you have a plot of numbers, X, Y, you know, and you just got numbers on this graph, what is the best fit line between these numbers? What is the line that minimizes the distance between each data point and that line? What is the best fit for that scatter diagram that's there, right? And that's called a regression. And again, there's all kinds of stuff: t-test, z-test, sampling, correlation, whatever. So I hit OK, and this thing shows up. And I got to choose a Y range, and my Y range is J. Remember, J is where I put the stock track average weekly results, right? So from J3 to J12. And then the X range is my S&P 500 weekly results. So on September 14th, S&P 500 was minus 0.64%, and stock track was up 1%, right? So the X is minus 0.64, the Y is 1. There's a data point on your graph. Fair? So you can plot these XYs on a graph, and they're going to be all over the place, right? What is the best fit line? So this will mathematically calculate it for you. And if I hit OK, it'll do it. And over here it says, where do you want this data to be outputted to? And it's going to say, my option is the new worksheet. So I have, what's the biggest number I have. I have worksheet number 9. So this is going to be worksheet number 10. It'll generate it. I hit OK. And there it is, sheet 10. And this gobbledygook comes out. So let me explain some of this. I'm not going to explain all the gobbledygook, but this number here by the X variable, it's really at the bottom. This is the gradient of that line. So it says, again, remember, my stock track portfolio lost money every week, whereas the S&P 500 gained a little on average every week, right? So we're going in opposite directions. So in this case, it's a negative number, right? Because if the stock market goes up, mine went down, right? I mean, there it is, the historical data. And so this thing is the beta of my portfolio. So beta is another measure of risk in the stock market. And standard deviation is absolute risk. It shows all the different ranges. But beta is how risky is your investment, whatever it is, to the stock market as a whole. So the stock market as a whole, by definition, has a beta of 1. Here, my portfolio has a beta of minus 0.22. So now let's look at, again, let's put it in perspective. Let me stop share and go back to the internet. Bear with me, please, bear with me. And we're gonna go to, here we looked at the S&P 500, we're in Yahoo Finance. What stock you want me to look at? Is Tesla okay? Can we look at Tesla again?
Yes.
Thanks. So I'm gonna go Tesla, because that's the stock we looked at last time, I think, pretty sure. And so Tesla's up 12. Oh, by the way, Tesla has now joined the S&P 500. So they kicked one stock out and they put Tesla in. So now Tesla is, which is a huge compliment to Musk and Tesla as a company, that it is now how Tesla does is incorporated in how the stock market is seen to have done. It's part of the S&P 500. So that just happened. It's really cool, right? And so the denominator changed a little bit on the S&P 500 in order to accommodate Tesla and make the, even though we now changing the S&P 500, we added a different stock, removed one stock, but to make the S&P 500 index be comparable to prior S&P 500 numbers, even though we changed the composition. So they do that by messing around with the denominator. Okay. So, all right. So Tesla, look at this. It has a beta of 1.97. This beta is calculated, the beta that we calculate on that graph was over a 10-week, my case, a 10-week period. This beta is calculated over a 5-year period, much longer data range, and based on monthly prices of Tesla versus weekly or daily. So it's a monthly data, but a 5-year period. So there are 60 data points, right? 5 times 12 in calculating this beta. Again, in my case, we only had 10, right? So, and you, strictly speaking, you need 15, 16 to make it that regression meaningful. But I still want you to do that exercise because I want you to know how to do it. So here's a beta of Tesla is 1.97, which means if the S&P 500, if the stock market goes up by 1, Tesla's going to go up by 2, 1.97, almost double, right? If the stock market goes down by 1, Tesla's going to go down by 2, or by twice as much as the stock market did. So if the stock market goes up by 5%, Tesla is going to go up by close to 10%. If the stock market goes down by 5%, Tesla is going to go down by close to 10%. Fair? Everything's percentages, changes. Questions? All right, I'm going to stop recording. Okay, resume a recording. I'm going to now share screen the stock track instructions. Show all windows, there it is. So here, can you guys see this Word document, the stock track investment challenge?
Yeah.
Okay. So this was uploaded again in Canvas, I think chapter 1. So let's read this. Your instructor may ask you, I am asking you, to turn in a written report describing your trading activities, as well as an evaluation of your portfolio's performance. So your performance will be graded based on your description of the investment philosophy, the execution of your investment strategy, and the evaluation of your performance and the documentation of your investments. Let's do each of those one by one. Description of investment philosophy is, what did you hope to achieve when you did this stock track game? What was your objective? Did you want to speculate and try some weird stuff? Did you want to win the prize, you know, the $100? Did you want to mirror a strategy that would be conservative and maybe a good strategy for you to do for long-term investment purposes like retirement? What were you trying to do? So that, what was your philosophy? We good on question 1?
Yeah.
Okay, question 2 is, all right, now that you've written down, you described for me, your teacher, what you're hoping to do, how did you do it? You know, why did you choose the stocks that you did choose? Why did you think those stocks would be a good choice with which to put in place the philosophy you have, which to do what it is you intended to do? Why did you choose those stocks? Okay. So if you chose 10 stocks, I guess we can have 10 descriptions. And you don't have to choose all 10. I just want to sample, right? Next thing is, okay, so, but any questions on that? Sorry, the question 2. Ingrid, did that make sense?
Yes, it did. Thank you.
Yeah, you're welcome. So next thing is, okay, you told me what you wanted to achieve. You told me what you chose in order to achieve this and why you chose it. Now is, how did that work out for you, right? And one way that we can evaluate this performance is the calculations that I asked you to do. What was your average weekly return? How did that compare with the S&P 500? What was the risk of that portfolio? What was your standard deviation? How did that compare with the S&P 500, right? You have a mathematical measurement of the results of your investment strategy, both return and risk. What was the Sharpe ratio of your portfolio versus the S&P 500? And then fourth is the documentation of your investments. So that's just from Stock Track. You know, I'm just making this up. You bought 100 shares of Tesla on this date, right? For this price. You sold it on the other date, or maybe you didn't sell it, you kept it. By the way, when you're doing the execution of your investment strategy, maybe you made a bad choice, right? I mean, and so it didn't work out for you. So that evaluation didn't work out, fine. And maybe you sold the stock. And why'd you sell it? Or maybe you made your goals and you made money. That's what, again, why'd you buy it? Why'd you sell it? Explain the trades that you made in your portfolio. Fair? Now, if you're in a group, your data points are the same, but you must each turn in a separate report. Your writing cannot be the same. You each have your own way of describing what you're hoping to achieve, how you went about trying to achieve it, and how that all worked out for you. Questions? How are we doing?
So by documentation, you mean the Excel sheet, right?
Well, the Excel sheet is the evaluation of your performance. Documenting your investments, I would go a little bit further than that. What were your actual trades?
So you just put them in the report then, well, more in depth.
Yeah, or a separate Excel sheet. You know, here's the stock you bought on this date for this price. This is what you sold it for, right?
So how long do you want the report to be?
Good question. So I am thinking in my head that the writing of it is max 5 pages, maybe 3 to 5 pages. And then you have a page, which is the Excel worksheet, right? And another page, which tracks your investments. So altogether, maybe 7 pages, right? 3 to 5 written and 2 Excel sheets. Does that make sense?
Yeah.
When I said 2 Excel sheets, I mean, what stock did you buy? What you sell it for? I would put in Excel, but if you want to put in a Word document, that's okay with me too. How are we doing? If you're running out of, if you can't make the 3 pages, one of the things you can also do at the beginning of the report is describe the game. Hey, you were given 100,000. You know what I'm saying? So that's right up here. Right? Put this in your own words. And then I am ambivalent about format. Typed, I got to be able to read it. And in professional English, right? You're not writing this to your BFF, right? This is a report you're giving to your instructor. Questions? Ingrid, are you okay with the detail here provided as far as what you need to put in your report?
Very happy. Thank you, Professor.
Yeah, you're welcome.
Thank
Good.
you.
You're welcome.
So like around, so the 3 pages of basically writing, and then
Yes.
the other 2 pages would be the Excel.
Yeah, I mean, so one page is the Excel worksheet that I showed you how to do, fair?
Yeah.
And the other page would be, you know, a little bit of a track record of what did you buy and sell, right? A little bit
Yeah.
idea of your activity. Now, if you didn't buy a single stock, then I guess that page is blank. Hopefully
So
you
I have
bought
a-
some stock.
I have a
Yeah,
question
Mitchell.
about that second page. So I kind of already made that along with my reasoning for each stock,
Okay.
but that's in a Word document. Should I like revise that and
No,
put
you don't
the-
need to revise it. I mean, that page that I'm talking about is, it's not necessarily, you know, a descript. I mean, it says, you say on September 10th, you bought, you know, there's 100 shares of Apple that you bought at this price.
So that's more like a blank log that you'd want.
A log. Yeah.
Okay.
Yeah, Mitchell. Does that make sense?
Yeah, because I also like wrote down like why I bought what I bought. So
Beautiful.
I mean, if you want a blank slate, I could get rid of that reasoning and just put that into my report.
No, don't get rid of anything. So this is just, you know, a quick overview of how many trades you made, what stock you bought, what date for what price. That's all. Something I can
Okay.
look at and say, okay, this is the activity. Then I'll read your report and you can describe why you bought it, right? Why you sold it.
Yeah. Okay. Thank you.
Sure.
Yeah. Well, I mean, yeah.
Okay.
Only thing that I was worried about was if I were to keep my, what's it called? If I were to keep my description of why I bought that in that separate page, I mean,
No,
that
no,
would
on the
kinda,
separate
like, cut into
page,
my report.
there is no description of why.
yeah, that's what I
There's
was
just
talking
what.
about. Yeah.
Fair?
Oh, and then the why is in the the report that you write, the 3 pages. Yeah.
Yeah,
The
the
why
why
is
is
in
in
the
the report.
report. Yes. And as you saying, as you're writing about the why, of course, you're also talking about the what, right? But that other page is just the what with no comments or explanations.
Yeah, just a log,
It's just a
basically.
log of your activities. Yes. A log of your trades. Is that helpful? Does that make sense? No?
Yeah.
Okay. Thanks, Mitchell. Any other questions?
When is the due date?
So, you know, before the end of the semester, don't give it to me on the last day of the semester. I got to read it. I got to grade it, right? Have a little bit of mercy on me. But I want to have mercy on you guys too, right? I don't want to say, I need to have it by next week or some nonsense. So just get it to me when you can, but before the end of the semester.
So basically the same as the homework.
Yeah.
All right.
Did you want us to email it or?
Yeah. So just like I mean, many of you haven't yet, but just like you will do or have done on the amortization exercise, I need you to email this report to me. And when you're emailing it, there obviously, you know, I guess you can scan it and make a PDF file of everything, or you can email me the Word component of it, 3 to 5 pages, and then the Excel sheet, right? A couple of tabs. One tab has the calculations that I showed you how to do, and the other tab has the log. Fair? Questions? All right, so lastly, on your report, when you write your report, you need to tell me who your teammates were. Teammates meaning who were part of your stock track exercise. And again, no copy pasting. Everybody's work needs to be separate. So next Thursday is Thanksgiving. We're not going to have a class. Are you guys going to be able to go back to your families? I hope.
Yes.
I hope.
If you don't tell the government.
Yeah, do what you got to do. Just spend time with your loved ones.
Yeah, who else is having a funeral for Thanksgiving instead of, you know, like Thanksgiving? Because apparently we're not allowed to do that thanks to the state of California.
I know.
So, but apparently funerals. So we're gonna have a funeral for Tom the turkey, because
I like it.
apparently, you know, Thanksgiving
like
isn't
it.
allowed anymore in this dystopian world. So
That's smart.
That is smart. Good for you, Ingrid. I like it. A funeral
family's
for the
being
turkey.
sarcastic.
That's awesome.
I'm having a funeral for my birthday since it's canceled tomorrow.
Oh, I hope
Oh,
you have a
well,
nice.
happy
Oh my
birthday,
gosh.
Zena.
I hope you have a nice funeral. We can literally say that now. Well, I hope you have a nice birthday. Yeah.
Happy birthday, Zena. That's wonderful.
Thank you.
Yeah, that's awesome. So can I tell you guys, oh, I better turn the recording off. Hold on. Stop share. Stop recording.